Hello learners, welcome back to our session. Remember in our previous class, my good students, we were looking at question number 5. And looking at this question, we realized that this question was literally coming from topic number 5. And we took that initiative of looking at the summary of topic number 5, which you should always be having at the back of your mind, right? In our segment today, then, I want us to dissect that question and work it out clearly, because this is a summary of what we should always be having in the event that you are talking about topic number 5. So back to our main question here. Look at this case. These are what you're told. I'm having a question here with us. I'm going to reshare it again so that all of us should be able to have it. And I believe it's visible. Remember, we had gone through the question. And as I've said, literally, you can basically download that question so that you can have it as Mwalimu is working it out. Let us handle part 1 of the question of required. We are told that the amounts, remember I'm not going through this question again because you had gone through the question. Remember in our first video, we had looked at that question, you had gone through that question clearly. So required here, part 1, we are asked, the amounts in shillings at which breaks in the marginal cost of capital, schedule, occur. So the good examiner is asking us here about what? The breakpoints, right? The breakpoints in our marginal cost of capital, Wmcc, the concept that we had just looked at earlier on in our first class. So let me squeeze this question a bit here. Majority of this information will be relevant. So squeezing it there, I want us to, I'll use this space that I know is visible to all of us. So, on this case, we are having our question that our good examiner is asking us to compute our breakpoints, right? Breakpoints. So I'm having our breakpoints here. This is what our good examiner wants us to compute. And remember, in our previous class, Mwalimu mentioned that breakpoints, of course, normally tend to occur in the event that you want to raise more capital to finance new projects, right? The concept now under Wmcc. So looking at the breakpoints, at this point, it is important for us to identify the component costs that I'll be having in relation to what was the structure, what was our capital structure, what were the components in our capital structure. And the components in our capital structure there, we can agree we had 2 components. That is a long-term debt. Just check below that where I'm having the source of capital. I'm having the long-term debt 45%, whereas equity capital I'm given 55%. So at this point, I need to compute the breakpoints of these 2 sources of capital, right? I need to compute the breakpoints of these 2 sources of capital. That is what you should be able to, remember. So on this case, what we should have is for us to remember, like for example, if I want to determine our breakpoint, basically our breakpoint, say like retained earnings breakpoint, because that is the first component that you're starting with, which literally I'm given there. So retained earnings breakpoint, this will be very easy. Retained earnings, okay, breakpoint. Retained earnings breakpoint. How will you go about it? So for us to determine our retained earnings breakpoint, this will be very easy, right? You just need to determine and look at what were we having in our retained earnings. So our retained earnings, basically you should be having the retained earnings available, right? Retained earnings available. And why are we terming it as available? Because remember, we want to look at cost of raising additional funds to finance what? New projects, right? So retained earnings available. Then what are you going to consider next, my good students? You're going basically here to divide by our value, which we are having what? The optimal equity proportion. Optimal equity proportion. because again, you should always remember that in this context, we normally tend to assume that even in raising these new additional funds, we should try as much as we can to maintain our existing capital structure. That is what we normally tend to talk about, and that is what we said in our classes. So in our case, in the event that I'm required to determine the retained earnings breakpoint here, I should be able to identify what are the retained earnings available. Then, in our existing capital structure, what is the optimal equity proportion? What equity can literally give to these new funds that we need to raise or to finance these new projects? So what is our retained earnings available in this case? Our good examiner had given us the proportion of our equity capital. But look at this case. We are told that the management of Kenzel Limited forecasts the after-tax earnings for the forthcoming year at 2.5. The company has been paying 60% of its earnings as dividends, and this payment ratio is expected to continue into the foreseeable future. So, if at all, my good students, your payout ratio is 60%. How much are you retaining? What is your retention? Therefore, you can agree here that my retention, therefore, is what? 40%. Because your payout ratio is 60%. That is to say, you are retaining what percentage? You are retaining 40%. And if I'm retaining 40% and you're given profit after tax here, which our good examiner has given us how much there? Look at that case, my good students, you're given profit after tax. After tax earnings, I'm given 2.5 million, right? That is after tax earnings, I'm given 2.5 million. So if I'm given 2.5 million profit after tax, therefore, and you know very well that having this case, therefore determining our retained earnings will be very easy. So therefore, you can agree and say that therefore my retained earnings will be as simple as taking my 40%, I'll be paying out our dividends. Payout ratio is 60%. Out of whatever that I'll be having, I'll be paying 60%, meaning that we're going to retain 40% of 2.5, which will literally give us what? If you take our figures are in thousands, because that is what you're given there, all other figures were in thousands. They are not in thousands, so you can take it full. Right? It's always very good to be consistent. So you can take it in full. So that should give us how much? Let me pick my calculator and see what we'll be having. So I'll be having 40%, 0.4 times 2.5. This will give me a figure of 1 million. This will give me a figure of 1 million. So after we have determined 1 million, were we having our equity proportion? Our equity proportion here, equity proportion, you can see very well that our equity proportion, you are given what rate? The equity capital, I'm given 55%. So I'm given 0.55. That is 55%. So therefore, what will be our breakpoint? Our breakpoint in this case, I can literally talk of, or we can literally work it out very easily here and say, I'm having the 1 million, which we have determined, divide by 0.55 to give us a figure of how much. I'm having, therefore, our breakpoint, retained earnings breakpoint, retained earnings breakpoint. Therefore, we should be talking of retained earnings breakpoint. I should be having 1,818,000, 1,818,000, 182 as per what Mwalimu is getting. So that will be our breakpoint, right? That will be our breakpoint when it comes to retain earnings. When it comes to retain earnings, literally, that is what I should be having as our breakpoint. So you'll find that the cost of this breakpoint is an issue of meaning that we can't literally obtain, or at that point, that is the maximum that you can literally have combined, right? So having that case, we proceed to the other bit, which was debt. If you can check debt, I'm given additional, I can have additional. But on the current, I'm having 45%. So in this case, what will we be having? Also, you are supposed to determine what? The debt breakpoint. But for debt breakpoint, I'm having it in terms of aspect of the breakdown between 0 to 500,000, 500 to 900,000, 900,000 and above. So therefore, it will be upon us to determine the breakpoint in relation to that. So this is what Mwalimu is going to do. Kindly clear that so that you can erase that and we proceed. So you can erase this point. So already we have determined our breakpoint in terms of our retained earnings. So here I should be having the, let me just erase all. So breakpoint in terms of debt, right? Debt breakpoints. Debt breakpoints. Debt breakpoints. In relation to our debt breakpoints, what will you be having here, my good students? In relation to our debt breakpoints, I'm having this in terms of our rates, or rather the aspect of the ranges that I'm given. So in this case, I should be talking of course, the debts available, right? So breakpoints, so debt breakpoints, right? The debt breakpoints, I should be having the debts available here. Debts available. We are going to divide all this by, of course, our debt proportion. Debt proportion. Debt proportion. So, according to what our good examiner has given us, I'm having debt in terms of ranges. So, like the first bit, I'm having aspect of 0 to 500,000, right? 0 to 500,000. So I'm having here the debt, the first debt available, 0 to 500,000. What will be a breakpoint at this point? Meaning that the maximum debt will be 500,000 in this range, right? So literally here, this will be simple. I'll just be taking my 500,000. We divide by the debt proportion, which was what? 0.45. Right? That should give us our value of, if you work it out, that should give us our value of how much? 500,000 divided by 0.45. I'm getting a figure of 1,111,111, right? So these are what you are getting between that range. If we proceed to the next range here of 0, not of 0, but now between 500,001 to, I'm given there a value of, so I'm having 500,000 to 900,000. So what will I be having? Of course, in this case, you take cumulative. Cumulative is 900,000, right? That is the maximum that I'll be having. Cumulative is 900,000. So that will just be simple. I'll take the 900,000 here, divide by 0.45 to give us what? To give us, basically, that should be 900,000 divided by 0.45. So that should give us a maximum of 2 million, right? 2 million. Kindly confirm if at all that is what we are getting. Kindly confirm if at all that is what we are getting. So you'll find that that was, of course, the first bit. This was at 9%. Right? Then the other bit, that was, of course, 11%. And basically that will stand for a maximum of how much? 900 and above, right? So we are talking of 13% all through. Up to 900,000 is 13% debt. Up to 900,000 is 13% as per what I was given there. So literally in this case, these are what we should be able to determine. These are what we should be able to determine so that my range here, based on our debt, if at all I was to look at based on our breakpoint, the one that is available, we should be having, of course, that is 0 to the list here is basically what? 0 to 1,111,000. If at all you are to look at our scale, so that one is going to affect us later on. Then in this case, we take our scale 1,101,000 to our breakpoint in terms of the retained earnings that we had. So in this case, in terms of our retained earnings, we had 1,812,000. Right? We had 1,812,812. That is what we had, 182. Then, of course, from that, 1,818,182 to a maximum of 2 million. So at this point, the examiner wanted us to have the two first of all. The examiner wanted us to have the two. The first point, that was for breakpoint in relation to retained earnings, and breakpoints in relation to what? In relation to basically our debts. So after we have determined that, we proceed to the second question. What were we asked on the second bit, my good students? The second part of the question, our good examiner is asking us the weighted marginal cost of capital in each of the intervals between the breaks in the MCC schedule, right? So this is our schedule. Actually, the good part we have also handled it because that will always be almost the next question. So this is our schedule here. This is our schedule. So in our case here, proceeding to what the examiner is asking us, which you realize that it is very simple. Let us proceed and check the other part, where in our schedule, which we have literally prepared, so our financing will range in between. Talk about our financing range. Financing range will range in between whatever that Mwalimu had given us earlier on, that is 0 to 111, then 111, to our figure, which is 1,818,182. Remember, this was the breakpoint in relation to equity. Then 1,818 to 182 to a maximum of 2 million. That is our financing range. That is a financing range. Then, in this case, we had two components, which was equity. Equity was, we had a weight of 5%, whereas our other item, which is debt, we had a range of a weight of 45% as per what I was given. So literally I can remove this question because we have everything, but most importantly, we need to understand whatever that I'll be having here. So have it. Then you can of course add another bit here, 2 million and above, the range of 2 million and above, the range of 2 million and above. Can I remove the question so that you can work it out? I know I can remove the question because literally we have everything now, almost everything. So removing the question, that would be very easy. So allow me to remove this question of ours, so that we use our full board, right? So the next thing is for us to determine, because I know very well that for us to determine a WMCC, I should be having our weights and of course our costs, right? The cost of this component, cost of capital, which in this case I'm having number one, we're having the aspect of what? We're having the aspect of retained profit, and we're having the ordinary share capital, because that is what was given there in terms of our equity, right? Equity capital, equity capital. Then I'm having another case, which is what? Which is debt. So therefore, what are we supposed to do? We proceed and work out our cost of equity. Remember, Mwalimu has told us that cost of equity I'll be having in terms of ordinary shares, which in this case, we had looked at that when you were starting, where we mentioned I'll be talking of the expected dividends, which expected dividends can literally be determined by taking the O1 plus G, all of this into aspect of PO minus any discount minus any flotation cost that I'll be having plus our growth rate. That is what we should be having here. So, cost of ordinary shares, what will we be having in this context of ours? What was our DO or D1 as per what you are given? As per what you are given, examiner, my good students, examiner had told us in paragraph number 3, the company corporate tax is 30%. The current market price of equity shares of company is 22. So, that is 22, right? Then market share. The company has been, or rather 22, last dividends on equity shares was paid at 2.2. So the last paid dividends was 2.2. So that is our DO. Into 1 plus growth rate. We are told that per share, and the expected growth rate is 5%. 0.05. 5%, right? We are going to divide all this by our PO, our market value. There we can see we are given 22. Did you have any flotation cost? I can see we are given flotation cost literally there, right? Flotation cost, you are told that they are going to incur, that is new equity can be sold, right? New equity shares can be sold at a flotation cost of 10% of the issue price. So 10% of the issue price. 10% of 2.22, that should give us 2.2 plus our growth rate, which is 0.05. So that should give us what? If you work it out, that should give you what, my good students? That should give you what? My calculator, if you don't want to give Mwalimu solution, 1.05 times 2.2, we divide by 22 minus 2.2 plus 0.05, I'm getting a figure of 0.166, so basically that is like 16.67%. Cost of equity, ordinary shares. What about my cost of equity, retained earnings? So DO into 1 plus G of our PO plus G. Because we don't have what? We don't have, in this case, we don't have flotation and discount on our retained earnings. So working it out, just a moment here. Should be having it, just a moment. So in this case, I should be having our case 2.2, 1 plus 0.05 of 22 plus 0.05. This should give us what percentage? That should give us 2.2 times 1.05 divided by 22. So that should give us I'm having 2.2 times 1.05 divided by 22 plus 0.05. So in this case, I'm literally getting 15.5%. 15.5%. Kindly confirm with your figures, my good students. Kindly confirm with what you're getting. Mwalimu is getting that value. Great. So once we have that in mind, then we can proceed to the next point here and be able to determine our cost here, right? So the cost here I'm having up to this point, right? That is, of course, up to whatever that I'm having, 0 to 11, I'm not going to issue any ordinary shares. So we are going to use basically our retained earnings, which is what? 15.5. You see? Maximum of up to this point, still I'm going to issue our retained earnings, which is 15.5%. But above 1.8 in relation to our equity, then allowed to issue our ordinary shares. And if we issue our ordinary shares to raise new capital, therefore my cost will be 16.67. The same case above 2 million, that will be 16.67. That is what you are having as per our schedule, right? That's what you are having as per our schedule. So this is in relation to what? This is in relation to basically our equity. That was in relation to our equity. And literally, that is how we should be able to do it. The whole concept that we are looking at here, my good student, is that what can we have as our maximum, right? We can't go beyond literally 1.18. So that is what you're having. And if we go beyond, that is to say we are talking of ordinary shares and they have to be issued to the public. And if we issue to the public, then the cost will be what you have computed here. So basically that is what you're supposed to do in that context. We proceed to the next item here. I need now debt. So for debt, again the same concept will apply. We can see that debt, we had various components in relation to what? In relation to basically our ranges, right? We were given 0 to 500,000, which was 9%, 500 to 900,000, which was 11, 900,000 and above, which was 13%, right? So the same concept will apply here. I want us to determine our cost of debt. I want us to determine our cost of debt. Cost of debt here. Cost of debt, we start with the first bit, which was given what percentage? 9% debt. 9% debt. So in that case, what will you be having in that case? So already my KD is 9. After tax should be 1 minus 0.3, which will give us what? So basically I should be talking over 9, or rather 9 times 0.7, which will give us 6.3%. 6.3%. Because remember already, I'm having it already, I'm given already the cost, right? So the other cost of debt here, which in this case was given, if at all, the cost of debt is 11%. So my KD, which is 11%. At this, what will I be having? 11 into 1 minus 0.3, which will give us what? Which should give us, of course, a value of 11 times 0.7 to give me 7.7. So it should be having 7.7%. Then lastly, we are given another debt. Remember, I'm doing this because I know you're having the question. If you can check the other debt there, I was given 13% cost, right? Cost of debt, 13%. What will I be having? 13 into 1 minus 0.3, which will literally give us what? 13 times 0.7. This one will give me 9.1%. 9.1%. 9.1%. So once we have that, we start by looking at it as per our range, as per our maximum according to what we are having. The first one, of course, will be the 9%, which is 0 to 500,000. So that one will fall here, right? That one will fall here. So I should be having 6.3. The other rate of 11, of course, as per what we had in this case, the other bit here, which will fall in between. That is what you are given there. That is 11, which will be 7.7. And also, that one is a maximum, remember, was 2 million. So therefore, that will also be 7.7. But above 2 million, therefore, I can see I'm having what? 9.1 as per the debts. So once we have that, things will be very, very easy now on our end to determine what the examiner wanted us to determine, the WMCC. The WMCC of each intervals, right? So WMCC of each intervals, this will be very, very easy now. So you're having the weight, we're having the weight, we're having the weight, and we're having the cost component. So assuming this is interval 1, 2, 3, 4. So my first interval, I should be talking of whatever that you have determined there, 15.5, right? Times the weight, which is 0.55, plus 6.3 times the weight, which is 0.45. Proceed to the next interval. Interval number 2, I'm having 15.5 times 0.55. We add 7.7 times 0.45, the weight. WMCC, what we did at our basic. Interval number 2. Interval number 3, I'm having 16.67 times 0.55. We add 7.7 times 0.45. Interval number 4, we should be having 16.67 times 0.55, right? In this case, plus 9.1 times 0.45. So very confidently, I can come and talk of my MCC, marginal cost of capital. Marginal cost of capital, that will be easy because I'll just be having my figures here. 15.5 times 0.55 plus 6.3 times 0.45. I'm having 11.36. So I should be having 11.36 here. The other bit, I should be talking of 15.5 times 0.55. We add 7.7 times 0.45. This should give me 11.99. 11.99. If you can check, 11.99. The other one I'm having 16.67. 16.67 times 0.55. We add 7.7 times 0.45. So you're having 12.63. And finally, should be 16.67 times 0.55. We add 9.1 times 0.45. 13.26. So that is what you are required to do up to that other bit, right? So that the next part of the question, which was what? The next part of the question, you are asked to determine the internal rate of returns, IRR, for project A and project C. And you can see it is the same project that I was given question mark for us to determine that case. So this is quite easy. And why is Mwalimu saying that this is easy? Because remember, at IRR, anytime you're talking about internal rate of return, internal rate of return, this is a rate that will equate our NPV to be equal to 0, right? That is the internal, or rather the rate that will equate our NPV to be equal to 0. So at this point, you must recall, how are you determining your NPV? Very important, your NPV. NPV is always very simple. NPV, we normally tend to talk of our cash flows, present value of cash flows minus our initial outlay. That is what will give us our NPV. So my focus here is on how many projects? My focus here is on the 2 projects that I was given question mark. And you are saying at IRR, NPV is equal to 0. At IRR, NPV is equal to 0. So if our NPV is equal to 0 at IRR, and all of this bit, basically, we are given aspect of what? We are given all these components that you are given here. Like check project P, right? Project P. What were we given in project P? Project P, in this case, that is where we are given a question mark, project A and project C, right? So project A, we are given a question mark, and project C, we are given a question mark. So it is upon us to determine the IRR on the 2 projects. So that will be simple, because if you can check there, and we take the figure that I was given, if you can check there and you take the figure that I was given, what was the amount that I'm having? Because at this point you are equating, this point you are looking at it as our NPV is equal to what? Our NPV is equal to 0. So NPV is equal to 0. Our cash flows, the one that the examiner had given us our cash flows to be, like for project A, kindly confirm. Project A, my cash flows, I was given a cash flow of 155,401 times our present value interest factor, right? Present value interest factor. It was not an equal amount, or in this case, by the fact that our examiner didn't guide us in terms of how many years this will be. So I'm going to have it as annuity. Given the rate and number of years, actually we are given the number of years to be what? 3 years, as per the examiner, right? We are given 3 years as per the examiner. So that is what you are going to basically consider. Project life of A is 8 years, not 3 years of A. The other one is 3 years for C, right? So the first one will be having 8 years. Minus initial outlay for project A, I'm given 675,000, right? Then project B, 0, cash flow is 161,524 times present value interest factor annuity. Rate, I don't have, 3 years, minus our initial outlay, which is 375,000. Now I can basically remove this bit so that you should all be on the same page. So whatever Mwalimu is doing here, we know very well that at our IRR, NPV is equal to 0. So this is project A, and this is project C. So looking at project A and project C, it is very simple, like we are given our cash flows. So it is upon us basically to determine the present value interest factor. It is upon us to determine our present value interest factor. Do you really want Mwalimu to do that for us? We can do that. We can do that, my good students. You can do that. We can do that. Let me do for the first one so that you can basically work out for the other one, right? So make present value interest factor annuity given the rate. You don't have the rate, but number of years, which is 8, to be what? To be the subject of our formula. So how are we going to work it out, right? So in that case, if at all you were to work it out, first of all, I'm doing for the first one here, we are going to take 675,000 on the other end, which would give us 155,401, right? 155,401, 155,401, present value interest factor annuity, rate 8. So this case, I divide all this by 155,401, 155,401, so that to cancel each other, we can therefore agree that this time I'm having my present value interest factor annuity given my rate 8 years to be 675,155,401, right? So you must be having your table now. You must be having your table. So you should be having 675,000 divided by 155,401, which I'm getting 4.3. I'm getting 4.34, 4.3436. So check this value in your table where you are looking at period 8. Which rate in your table will give you this value? Which rate in your table will give you that value? So it is important for you now to be able to understand how to use that rate, how to use the rate. So if you can check in our table, I can see the value of 4.3436 corresponds to this value here. This value here corresponds to 16%. That value corresponds to 16%. That value corresponds to 16%. So this is what you're supposed to do in that bit. So I want you guys to do for the other one. So that next time when we meet again, we are going to look at another concept. that point, thank you so much, and let us meet in the next session. Thank you.